there's this metric, which is perhaps the most important of all. The red line is the price-earnings ratio of the Standard & Poor's 500 index dating back to the end of 1988. The black line shows the price of the S&P 500 in the same time period. Earnings, the red line, drives stock prices, and when stocks are fairly priced, the black line and the red line are close together. In the tech stock crash and bear market in the turning of the millennium, the gap opened between earnings and the price of the S&P 500. There was no such valuation gap in January 2016. In fact, if earnings come as expected, the red line will pull the black line higher. No one can predict what will happen. Terrorism, natural disasters, politics, and so-called black swan events that no one could expect can become reality and change financial markets dramatically at any given moment. That's always been true, although it seems harder than ever to believe. Over long periods of time, however, we know humans make progress. We learn and make things better. In a volatile world, betting on the progress of humanity is never easy. Barring some unforeseen calamity, however, progress will slowly come to humanity in the years ahead, and the red line, earnings, will pull the black line higher. There's a lot of uncertainty and emotion that could pull the market down further. But try to keep these economic fundamentals in perspective.
This chart shows the price-to-earnings ratio of the companies in the S&P 500 going back to 1990. The P/E ratio tells you how much investors are willing to pay for $1 of earnings. Look at how, during the period around the tech bubble at the turn of the millennium, investors were willing to pay nearly $30 a share for every dollar of profit earned by a company in the S&P 500. Such extremes in stock valuations are signs of irrational exuberance. Looking at the valuations placed on stocks over the past 25-year period shows that investors have been willing to pay about $17 for every dollar earned by a company in the S&P 500. That market multiple of 17 is the average valuation placed on stocks by investors in a low-inflation environment, like we are currently experiencing. Look at the period highlighted by the dotted circle. Investors went from a market multiple of 12 in the third quarter of 2011 to 18 in the fourth quarter of 2014. Currently, the market P/E ratio is about 16. While it's below the normal market multiple of 17, the higher valuation level makes the stock market more susceptible to emotional or even irrational drops. The expansion of the market multiple is what propelled stock prices over the bull run that accompanied the recovery from the Great Recession. Stock prices enjoyed an uninterrupted 4-year bull run from August 2011 through August 2015. Lots of bad news occurred in that period, but stocks shook it off and climbed higher. When considering this huge long-term bull market and stocks recovering to a more normal valuation level, it makes sense for stocks to pause. No one can predict stock performance. It is reasonable to expect sideways motion with continued volatility in stocks for now. We're here to help you make sense of irrational market behavior and help you avoid being part of it.
The Standard & Poor's 500 index rose 1.6% last week, but the big blue-chip U.S. companies closed down fractionally on Friday, despite some very positive economic data. Data released on Friday, February 26 by the U.S. Commerce Department showed discretionary personal income rose 4% from a year ago. That's a sharp increase and is evidence that consumers are reloading and could fuel another growth phase for the U.S. economy. Also on Friday, the government changed its estimate of U.S. economic growth in the fourth quarter of 2015 from 0.7% to 1%. But if you look behind the GDP growth figures at its components, the outlook becomes even more encouraging. This chart shows you the 4 cylinders of growth in the U.S. economy. These 4 cylinders are not created equal. The most influential one is the upper left. personal consumption accounts for about 70% of economic growth. Now, even though the most recent personal consumption data from the fourth quarter of 2015 showed a dip, the four cylinders are positive and indicate that the long-term growth trend remains intact.